Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and I'm a first-time guest on the show with me today. We're going to be talking about the economy, coronavirus impacts, what is happening in real estate, the impact, the fallout, what's taking place in real estate, maybe safe havens. With my next guest, Kathy Fettke is the co-CEO of Real Wealth and best-selling author of Retire Rich and with Rentals, Retire Rich with Rentals. She's an active real estate investor, licensed real estate agent, and former mortgage broker specializing in helping people build multi-million-dollar real estate portfolios that generate passive monthly cash flow for life. Doesn't that sound nice? And I'm somebody who owns real estate, and in this environment, I have tenants right now that I'm concerned about actually paying their rent. So I have a lot of questions for Kathy today. Her website is realwealthnetwork.com. Kathy, thanks so much for joining me here at Crush the Street.
Thanks so much for having me.
Okay, so let's start here. We have a situation where more than 2 billion people around the world are in some form of a quarantine. I, for one, am. I assume you are as well. The economy is coming to a grinding halt globally. Interest rates have been slashed across the board. We even have the 3-month bond in negative territory right now. Yeah. Just let's start off here. What are some of your initial thoughts with the coronavirus and its impact on the economy?
Well, it's getting more and more obvious now. I was aware of it right away because when I started to see what was happening in China and that they were building hospitals and locking people into their apartments, it was concerning to me right away. So I dove in to understand it, and I'm an early adopter, so I got it quickly. I was shocked that it took so long for Americans to understand it. Somehow thinking that it wouldn't get here, even though there's travel and flights to and from, even with flights not coming from China, there's, you fly somewhere else and fly in. So it was a little naive, in my opinion, to think that it wouldn't get here. And yet we weren't doing anything to stop it. I was, because I'm asthmatic and I can work at home. So I canceled all travel and started working from home and realized, well, I could get a lot more done if I were, not traveling all the time. So we saw it early, we prepared, but that's what I've been doing at Real Wealth. That's my job as visionary. We follow the EOS model, which is you've got the visionary and the integrator, and my job is to see what's coming. So we were ready and prepared months ago. But with that said, what about our tenants, right? Our business is helping people invest in rental properties nationwide and emerging markets that have job growth and population growth. And we help people, buy rental properties that have a tenant already and have management in place and so forth. So of course, this was going to affect our business. It was going to affect our members at Real Wealth, our teams that are going out and finding the properties and renovating them. I mean, it would have a huge impact, and we didn't know quite what that impact would look like. But I'm in California, and California is an early adopter. So I quarantined myself. I didn't let anyone visit at all. And then California was quick to quarantine or at least ask people to stay at home. I mean, now our beaches and our trails, everything's shut down. So we were early to see, okay, this is going to have an enormous impact if restaurants are shut down and hotels are shut down. I'm personally not flying. The people who have these jobs, well, they are our tenants. What are they going to do if they're not working? So up until yesterday, we have been working with our property managers nationwide to find out, what are you going to do to collect the rent? How can we help these tenants? Do you want to give them a discount for paying early? Do you, just find out how many can keep their jobs and work from home or are in essential businesses? I mean, every day has been a new discovery. Like, how are we going to handle this? And then, of course, even if you have tenants who haven't been paying their rent, you couldn't evict them, even if it had nothing to do with this virus. They just, weren't paying. So that was going to put a lot of pressure on our landlords who aren't in a position to just cover everybody's rent. So until yesterday, I couldn't sleep last night because I went through the new $2.2 trillion recovery bill, and it's kind of, but there's two parts to it. Like, it will get us through this crisis through the next 3 months, because it's written in a way that there's the payment protection program. I don't know how much you've read about that. Have you?
I mean, I know, I'm familiar with it. I'm familiar with it helping businesses pay their 1099 employees or regular employees. I know
Yeah.
that, everyone's getting a $1,200 check plus more if you have kids
Well,
under, there's a lot of different things.
there's so many things. So first off, if you're a taxpayer, it's my understanding you're going to get a $1,200 check. So that's going to help a lot of people pay their rent. But there's no requirement that it go to rent, right? But people will be getting money. And if there's 2 people or 3 people living in that household, that's possibly more money than they were earning before. And then I started to study this paycheck protection program because I'm an employer. We have 20 employees and another 20 contractors. And, my husband and I have tried to figure out how we're going to, do we need to downsize? Do we need to cut salaries? Because we're in real estate and we're obviously going to get affected. So I read this bill. It's the phase 3 of the COVID-19 relief bill. That's the government is wanting employers to retain their employees, because we saw 3.6 million people file for unemployment in 1 week. So that's going to probably happen again this week and then next week. And that's unsustainable. That's nothing this country's ever seen. Of course, we were all panicked about that. 50% unemployment. How does an economy adjust to that? But then I read this bill, and as much as I hate giving out free money, and I know the implications of that for our future, what's interesting is that if you've got 10 million people filing for unemployment, they're going to get unemployment checks. So doesn't it make more sense that the employer get that loan and retain their employees and hire back the ones they had to let go of so they don't go on unemployment? Either way, they're getting money from the government, right? So this bill basically gives employers a loan that is kind of equal to 10 weeks pay of their, of their salaries they need to pay, their payroll. And that loan is forgivable if you retain your employees. So basically, it's like the employer's getting the free money in order to retain the employees. And instead of them being on unemployment, now they can still work. And as an employer, I can maybe say, hey, you have to work at home. And let's say it's a restaurant. Well, maybe you can just work on social media or a new plan, just something, something so they're still working. And I kind of think it's brilliant for now to get through this crisis. And that brings me back to, I had 2 scenarios in my mind of how this was going to play out for the short term. And that was, oh boy, we're in for big trouble. No one's going to be able to pay their rent. Businesses are going to fall apart. But instead, what our government has done is come in with the biggest rescue package ever. And I actually think if we can get a hold, get this virus under control through the containment processes that seem to have worked in other places, if that's possible, and that buys us time to find the cure, to find the vaccine, to contain it, to help our healthcare workers while people are still getting paid, this could be kind of a short, kind of like a hurricane that comes in, wipes things out, and then you're back up and running. So that's one potential scenario for this. The other is that
go ahead. I didn't mean to jump in there.
It, right? Sure. In the long run, let's face it, in the long run, we're going to be different after this. I was somebody who was on a plane every single week, traveling, speaking about real estate, teaching people how to invest, how to create cash flow through acquiring assets and so forth. I was a keynote speaker in a different city, sometimes twice a week. I haven't left my house for 2 months, and I actually am loving it. I'm remembering what life is like when you're not going 100 miles an hour, and I'm enjoying it. And I don't know if that'll be the case for other people, but I just don't know that we're going to return to what things were after this. So that's one side of it. The other is there's absolutely going to be an impact from all this free money. And that's what we need to look at long term. What happens when the Federal Reserve comes in, prints $2 trillion in this rescue package plus unlimited rescue for the banks, which is what basically is happening. They're saying 4 trillion, but really it's unlimited. They haven't put a cap to it. That's the bigger issue. That's the long-term issue. And that is my concern for most people who don't own assets. If you own the dollar, basically, if you're working for the dollar and the dollar is being flooded, I mean, $6 trillion more being thrown into the economy, that basically devalues the dollar, and people are paid in dollars and people save in dollars, and they, that's going to be affected. Whereas, in my opinion, when you take those dollars and trade them for a hard asset like gold or like real estate, or a business that's got good fundamentals, then you get to ride the tide up. You have the assets that tend to go up in value when the dollar value goes down. So those who are able to acquire assets, they're going to probably see those asset values increase, while those who don't it's just going to be a bigger income gap, which is not good for the future, in my
Absolutely.
opinion.
Yeah, I would agree with you on that. It's an interesting world we're seeing the largest stimulus injection package ever in response to this. And, interesting perspectives too on if it's going to be a positive thing. Get us through the cure, right? That's what you're saying. Get us through this coronavirus and then let the chips settle. But my critique of that would have been what you just addressed. And that's, what is the fallout? I mean, where does this ultimately go? And interestingly enough, just like we saw over the last 10 years, the people that were hurt the most were the people who didn't own assets, right? If you didn't own real estate in 2011, 2012, and then you had to buy real estate in 2018, you were disadvantaged, right? You had to pay a lot higher prices than those who owned very early on. And I feel like that's going to be the similar situation going forward here with all this newly printed money. So having said some of that, what are some of the best locations? What are some of the best safe havens that you've seen historically, through different crises that's held their value and that you believe are great locations to own assets going forward here, especially as we see this reflation take place with the money printing?
Well, believe it or not, nothing is really changing in our strategy, because it sounds like you've been on the same page as I am, where this is not a new problem. This is an old problem that started in 1971 when Nixon took us off the gold standard, and and basically let politicians get as much money as they need or want to get reelected. It used to be that our Constitution knew that if you allow politicians to print money, they will, and that would create a fiat economy, a fake currency that it doesn't usually end well for countries that have done that. So our Constitution doesn't allow the printing of money, but it does allow the borrowing of it. And that is, when the Federal Reserve was created, that was its purpose, to basically get around that constitutional limitation. And the Federal Reserve can print money. It's not a government entity. It's the banking system. They can create the money and lend it to the U.S., and then that becomes constitutional. That wasn't really what our forefathers wanted for us. So that is basically, that started, at the beginning of, in the beginning of the 1900s. And then as more money was needed in 1971, Nixon said, well, we need more money than we have gold. So we're just going to, take us off that gold standard and have the dollar be the new gold standard. And other countries bought into that. So then the printing presses really went off, of course, after 2008. massive. I mean, we can look at that scenario and say, okay, we took advantage of this ability to create money out of thin air and went crazy lending in the early 2000s. Lending any kind of money you wanted, you know, you don't have to prove you have the ability to pay it back, and you could buy assets. Well, that didn't end well, because it turns out people did need to make their payments on those. And we saw a housing crash. The way to fix that, the Fed said, well, we'll just pour more money in, trillions of dollars, into a recovery that was really kind of a fake recovery. But what we saw in that was asset values go up. So we had an economy that was ready to collapse in 2008. Giant companies, financial giants, collapsed before our very eyes. And the banking system almost completely shut down in 2008. So the solution for that was, again, pouring money into the economy. And the results we saw from that were stocks went up and real estate values went up, but salaries really didn't. And that's why we started to see this massive income gap. Now we're doing it again and saying, okay, we're going to even go bigger this time. We are going to just unlimited quantitative easing. They're not calling it that, though. They're calling it, I don't know what they're calling it now. It was started as repos back in September. But this is a massive stimulus program that people are loving because they're getting free money. I'm excited. We've already applied for this Paycheck Protection Program because it's going to give us 10 weeks of salary to pay our employees. 10 weeks, and then that loan is forgiven. I mean, it's incredible. Who wouldn't want that? You got to take advantage of it because it's free money. But at the same time, what's the impact? And my guess is it will be the same thing. I don't believe that real estate will take off in the way it has, and I don't think stocks will. The way I see it is we have major deflation happening. The air is coming out of the bubble. Where there's bubbles, the air's coming out. And so this stimulus is going to bring it back in a false kind of way. I don't think it's going to go through the roof of lack of affordability, although it will be. It's just going to keep it from deflating. It could kind of hold it up, and at least until the election. So I think there's obviously political reasons here to, at least till November, this is, they're going to hold it together. And then what? So, we've been expecting this. This is why everything we've done at Real Wealth has been in anticipation of something, some trigger, some black swan that would, poke into these bubbles. And the bubbles were basically stocks. We were really advising people to be careful in the stock market and definitely not invest in any companies that had high debt. And then the same with real estate, like stay out of the cities where people invest in the stock market. Because this time around, the real estate market is not the problem. People have had to qualify for these loans. They were difficult to get. They had to put down payments. Many people are locked into low rates with home prices that were much lower, and they have equity. So it's really not housing as the problem this time. It's the corporate debt. It was the overblown stock market. So the cities that are invested there, it would be New York, it would be San Francisco, LA, the real bubbly places, maybe Seattle, that will take the fall, I think, with their real estate values, with their, anyone who is expecting, corporate stock payout, or if they're going to be more affected. But the cities that do the manufacturing, the blue collar workers, the people who keep this country going, those areas, they never really bubbled up and they never really collapsed in 2008. They're just steady blue collar markets. So this city might sound really not sexy to you, but one of the areas that we have seen tremendous cash flow and appreciation is Detroit. Now, a lot of people are like, why would you invest in Detroit? Well, as a real estate investor, we're always looking for the bargain, the deal that's, what's discounted. Now, Detroit was super late to recovery because the city went bankrupt, not, pretty late into it. I think it was 2013 or 2014. So much debt, these labor laws that were not useful for employers and made it difficult for employers to hire. When the bankruptcy happened, there was a complete restart in Detroit, but it didn't really start till 2015. And it was just kind of revving up. And we were still finding properties in the, I don't know, $40,000, $50,000 range that were A-class properties, good schools, good neighborhoods, 3-bedroom houses, no crime. I mean, of course, outside of Detroit and suburbs. And picking those up, and then they've doubled in value since then. But we're still buying these beautiful homes for $80,000, all renovated. That's after all renovation, with a tenant that, was used to paying around $1,000 a month. So that was just an area that it wasn't in a bubble. It was still growing. Prices hadn't come back. Rents were high, home prices low, and manufacturing. So that to me made sense. Now, are the big three having trouble right now? I mean, sure, who's going to be buying cars over the next 3 months? But at the same time, look what they're doing. They're shifting. We have a president, and now I think a population in America who's like, we cannot be dependent on other countries for the things that we need. What a shocker to realize, wait, we need medicine. We need masks. We need ventilators. And we have to import all of that. And the countries that normally would export to us, well, they need that stuff because they're going through the same crisis. They don't have extra for us. That was an eye-opener, and that will change America forever, where people will realize we need to be manufacturing. And guess who's doing it? Detroit. They're GM, Ford, they're coming in and changing everything to make these ventilators. We've got American companies coming in and making masks and figuring out how to make the medicine that people need, not just for COVID, but for anything. People that need their medicines to survive and live on, it's not being imported. So like, aha moment, we need to make it here. So it's my opinion that any city that's been great at manufacturing, I mean, those are the cities that are going to recover. The paper asset cities, the stock market cities that don't create anything except trading money, I don't know if they're going to do as well. So that's why bullish on Detroit, bullish on Cleveland. Cleveland's a huge medical hub. The good blue collar cities of America, that's where we're investing. The homes are cheap. People are used to living on less. They're not as affected by the stock market because most weren't invested in it. That's the kind of housing that we're providing at this time.
I'm just curious. Any other cities? You mentioned Cleveland, Detroit.
Yeah.
Do you look in Tennessee or Texas or Florida?
Dallas has been our steady Eddie for years. I mean, we started helping investors. Rich and I had the honor of having, I have the podcast called The Real Wealth Show. And at the time in 2005, when I started that show, it was on a radio station in San Francisco. That was before podcasting was even a thing, before all of this. So I had a radio show. It was called The Real Wealth Show. I really wanted to understand money, how people make passive income. I didn't understand it. And I used my show as a way to get smart people on and let them, have them talk to me. They wouldn't normally talk to me. But I was able to get people like Robert Kiyosaki on my show in 2005. And then I was like, Robert, what's going on? Anyone could get a loan. This debt doesn't make sense. They're not gonna be able to pay it back. How's this gonna play out? And he, this is, again, nothing new. He told me this 15 years ago. He said, you got to sell the bubble assets and get into areas where they have manufacturing, where they have real jobs. So it was back then that he showed me, sell all of our assets in California and exchange them 1031 deferred. So, we didn't even have to pay taxes selling those assets and buy properties in Dallas because of all the job growth, because of the job friendly environment, the population growth. So back then, Rich and I jumped on a plane and we bought 12 properties in Dallas because at the time, you didn't even have to have a down payment. I mean, that's how crazy the lending world was. You just could buy properties back then. So we did, and again, sold our California properties. And Dallas continued to grow over that time period. During the housing recession, sorry. during the 2009 collapse, our properties didn't even feel it. In fact, the properties that we bought in the growing parts of Dallas, they tripled in value over that period when there was a massive housing recession. Our properties tripled in value, and they never were vacant. Constantly, because we bought in good areas, good schools, but we looked at the fundamentals, which was the job growth, the population growth, and the affordability of those properties. So we still like Dallas. Dallas prices have gone up quite a bit. It's not as good a deal as it was 15 years ago, for sure. But there are parts of Dallas that I still like. There's even parts of Houston. I think Houston might get hit harder because it's still a little more dependent on oil. Dallas is not. But we still like parts of Houston because it is very diverse. Just a little bit more dependent on oil. And of course, oil is getting, it's so manipulated. So it's getting hit really hard. We do like Atlanta because it's so diverse. Lots of the entertainment industry has moved to Atlanta, a lot of the tech industry. And those are things I think we're going to see more of, right? I mean, entertainment's huge right now. So people are doing while they're in quarantine. So, we do like Atlanta. Again, prices are a little higher than in the other, like Cleveland and Detroit. And then Florida. Florida is kind of a question mark because on the one hand, places like Orlando and Miami, very dependent on travel and tourism. And I don't know how that's going to go. I mean, are people going to jump back on planes? I just don't know after this. We're not sure until there's a vaccine that this virus isn't going to be floating around for a while. So until there's a vaccine, I'm a little concerned about areas that are dependent on tourism. But at the same time, you got a lot of people saying, boy, I really wish I lived in a house right now. So you've got all these New Yorkers been cooped up in their apartments, maybe rethinking life. Maybe life will never be the same for them. And many of them are moving to Florida. They were already moving to Florida because of the tax benefits. The tax benefits are incredible for living in Florida. No state income tax, and low property tax and low home prices. I mean, you could still buy a house. We're building houses in Florida and also helping investors buy rental properties. And we have not seen a slowdown. We have seen steady flow of people wanting to rent these single family homes and buy them. And many of them are coming from New York. Now, Florida's saying you can't come here till you quarantine for 2 weeks. We don't want you to bring anything with you. But we have not seen a slowdown at all. So parts of Florida that are not dependent on tourism, I think are going to continue to do really well due to the fact that people are learning how to live it, work at home. A lot of companies are realizing, wow, this works. Our employees actually can work at home. So I think there's going to be more of a desire for people to have a yard, have a home, not be so close to other people, just in case this ever happens again. It's really, I believe it's going to change the way we think and the way we live. And people are not maybe going to want to live so close to each other.
Good point. And it's something I don't know. I guess I never really wrapped my mind around that concept of not wanting to be as close to people after this. Obviously, I knew this was a 9/11 moment in many ways, but I guess I never really considered that fact and then the implication of what that will do to people that live in apartments, creating a demand for actual homes. So then Florida is a good place to go, right? It's warm and there's good climate for financials in Florida as well. Yeah. Kathy, we are right at the 30-minute mark. I want to appreciate you so much for coming on Crush the Street, sharing your wisdom, sharing your thoughts. I mean, you open with us on the implications of the severities of what this is doing to the economy, and then also the fallout. I mean, I think you really articulated the money printing, which I think a lot of my audience understands that this is going to have an impact on the economy. It's going to enter the system in some way. And I agree with you. I think real estate is going to be a place that this $2 trillion finds itself ultimately. So thanks for bringing that to our attention. If people want to learn more about you, what you do, the content you put out, and what you do for people, please let them know where they can go and what they can expect to find.
Sure. It's Real Wealth Network, real like real estate, wealth like your money, and network as in the teams we have across the country who help our members, find properties that are discounted, get them renovated, and a qualified tenant with property management in place. So realwealthnetwork.com. I also have the Real Wealth Show, which is a podcast, and Real Estate News. It's a daily podcast on all these changes happening. It just keeps it 6 minutes, 7 minutes, keeps you on top of what's going on. Those are the main ways to find me. I did write a book called Retire Rich on Rentals. So I get people real excited about rental property, but then I want to say, stop. You got to do it right, or you will lose all your money. Don't do it wrong. You've got to go through this checklist, which we have on our website and in my book. So I caution people, don't get too excited about real estate because you can really blow it. You can make money, you can lose money. You just got to follow the checklist. Just like I wouldn't want to go out and buy stocks. I don't know what I'm doing with that. So I'm not going to just go buy stocks. I would want to understand how to do it. Same with real estate.
Thank you.
And I do want to just say one thing. You said 2 trillion. It's 6 trillion. $6 trillion at a minimum. And I do agree with you. It's going to end up in some form of asset, most likely real estate, because the 4 trillion is going into the lending. Banks want people to keep borrowing money for what? Real estate. So I think that $6 trillion, a lot of it will be going into real estate to keep values up.
Yeah, well, and let's not forget that taxes have been cut in half too. So, which exactly. I'm actually a little more for that sort of an incentive, but that's money that the government's not going to have. So that's another $1 trillion that's being added. So absolutely. Kathy, again, thank you so much for coming on Crush the Street with me today.
Thank you for having me.